Imagine waking up tomorrow and seeing a headline that says, "The United States is slapping a 100% tariff on everything coming from Canada." Not 10%, not 25%, 100%. You check futures markets and they're red. Bond yields are spiking. Gold is ripping higher. Analysts are using words like structural shift, reserve risk, and capital flight. It doesn't feel like a policy disagreement. It feels like the ground just moved. That's the scenario now on the table after Trump threatened to double the price of all Canadian imports in response to Canada deepening trade ties with China. And this isn't just another loud headline in a loud political cycle. This is about whether the post-World War II economic order, anchored by the US dollar and North American trade integration, can survive another escalation. Because if this spirals, it won't just be about lumber or dairy. It will be about the dollar, global capital flows, and whether Wall Street still sees America as the safest bet on Earth. The deal that lit the fuse. The spark came when Canada's leadership returned from China with reports of tariff reductions and renewed trade access across billions of dollars in goods. Agricultural exports reopened, select industrial barriers eased, travel restrictions softened. On the surface, it looked like standard diversification, one country broadening its trade relationships in a multipolar world. But from Washington's perspective, it looked like something else entirely. It looked like a strategic shift, a U.S. ally cutting deeper economic ties with America's primary geopolitical rival. Trump's response was immediate and aggressive. If Canada strengthens its trade alignment with China, the U.S. would respond with a 100% tariff on Canadian goods entering the American market. That's not a negotiating tactic in the traditional sense. That's economic brinkmanship, and Wall Street understands what that means. Why a 100% tariff isn't just a tax, it's a shockwave. A 100% tariff effectively doubles the price of imports. Canadian crude oil, lumber, auto parts, agricultural products, many of which are deeply integrated into American supply chains, would instantly become far more expensive. The U.S. auto industry is not neatly domestic. Parts cross the US-Canada border multiple times before a vehicle is finished. Energy flows are intertwined. Regional grids rely heavily on Canadian natural gas and electricity. You can't just buy American your way out of that overnight. If such a tariff were implemented, inflation would likely spike quickly. Energy prices would rise, auto prices would climb, construction costs would increase. And because Canada would almost certainly retaliate, American exporters would be hit as well. But here's the part that truly worries markets. It's not just about higher prices. It's about uncertainty. Capital hates unpredictability more than it hates taxes. The bond market is watching closely. While the political rhetoric dominates headlines, the bond market is quietly sending signals. When global investors fear instability in U.S. policy, they demand higher yields to hold U.S. debt. That pushes borrowing costs up across the entire economy. And at the same time this trade tension is escalating, something else has been happening. Central banks around the world have been increasing their gold reserves. In fact, global central banks now hold more gold relative to U.S. treasuries than they have in decades. Gold recently surged to record highs. That's not just about inflation, it's about confidence. Gold tends to rise when trust in fiat stability wobbles, when foreign governments diversify away from treasuries, even gradually. It forces the U.S. to offer higher yields to attract capital. Higher yields mean higher mortgage rates, higher corporate borrowing costs, and more pressure on federal deficits. In other words, trade policy can feed directly into financial conditions. One of the rarest and most concerning dynamics in markets is when stocks, bonds, and the dollar all weaken at the same time. Normally, if stocks fall, money flows into treasuries. If global tensions rise, the dollar strengthens as a safe haven. But when investors begin viewing U.S. policy itself as the source of risk, that safe haven status can weaken. Recently, analysts have described a rotation in global portfolios away from concentrated U.S. exposure. Sovereign wealth funds and pension managers are reportedly diversifying more aggressively into European, Asian, and commodity-linked assets. That doesn't mean the dollar collapses tomorrow, but it does mean the perception of American stability, once taken for granted, is no longer unquestioned. And perception in global finance is everything. Canada's strategic pivot. Canada's response hasn't been defensive. It's been adaptive. Rather than framing its China engagement as an alliance shift, it has presented it as diversification. Strengthen ties with Europe, expand engagement with Asia, deepen participation in multilateral trade networks. In economic terms, diversification is rational. For decades, Canada's economy has been deeply tied to the United States. If that relationship becomes politically volatile, building alternative trade corridors becomes prudent risk management. And here's the key. Once alternative supply chains and trade relationships are established, they don't simply vanish when tensions cool. Businesses invest capital, relocate logistics, and reprice risk. Even if tariffs are never implemented, the signal alone can shift long-term strategy. The dollar's silent risk. The real underlying issue is the dollar's role in global trade. The dollar is powerful because it is trusted. Oil is priced in dollars. Global debts are denominated in dollars. Central banks hold dollars as reserves. If enough countries begin settling trade in alternative currencies, or increasingly holding gold instead of treasuries, that system slowly fragments. Not overnight, not dramatically, but gradually. The United States carries over $30 trillion in debt. That debt is manageable, largely because global demand for U.S. bonds remains strong. If confidence erodes and yields rise structurally, debt servicing becomes more expensive. That's when fiscal pressure intensifies. That's when markets start asking harder questions. And that's why the tariff threat is bigger than it sounds. 3 paths from here. There are realistically 3 broad scenarios. In the first, rhetoric cools. Negotiations happen behind closed doors. Symbolic concessions are exchanged. The 100% tariff never materializes. Markets stabilize, though some reputational damage lingers. In the second, partial tariffs are implemented. Retaliation follows. Trade flows adjust. North American integration weakens over time, but no immediate collapse occurs. The cost is slower growth and higher long-term volatility. In the third, escalation accelerates. Full tariffs hit. Retaliation compounds. Supply chains fracture rapidly. Inflation spikes. Growth contracts. Confidence in U.S. fiscal stability faces meaningful stress. Markets are currently pricing somewhere between the first and second scenario. But the reason gold is surging and bond yields are volatile, is that the third scenario, while unlikely, is no longer unthinkable. And markets don't wait for certainty, they move on probability. The real question. This isn't about partisan loyalty. It isn't about defending Canada or criticizing America. It's about understanding leverage. When a country weaponizes trade against close allies, those allies don't disappear. They adapt, they build alternatives, and over time, alternatives reduce dependency. The American century wasn't built solely on military power. It was built on economic reliability, predictability, open capital markets, rule-based systems. If global partners begin questioning that reliability, the shift won't be loud at first. It will be gradual. Portfolio by portfolio, trade agreement by trade agreement, reserve allocation by reserve allocation. And one day, people will look back and say the signs were there. What this means for you. For investors and business owners, this moment is less about panic and more about structure. Diversification across geographies matters. Exposure to commodities and real assets matters. Understanding how bond yields influence everything from mortgages to equity valuations matters. You cannot control geopolitical strategy, but you can control concentration risk. If this de-escalates, markets will likely rally sharply. If it escalates, volatility will accelerate quickly. The danger isn't in headlines. It's in structural shifts that compound quietly. Right now, gold at record highs, central bank diversification, bond yield volatility, and rising trade tension are flashing signals. Not collapse, not inevitability, signals. The question isn't whether a 100% tariff will actually happen. The question is whether the world is beginning to price in a future where American economic dominance is no longer automatic. And that's a much bigger story than a trade dispute. Because once trust shifts in global finance, it rarely snaps back the same way. The next few months will determine whether this was just another loud moment in a noisy era, or the beginning of a long-term realignment that historians will one day trace back to a single tariff threat. And if you're paying attention now, you won't be surprised later.